When I opened my first bank account many years ago, it was a very simple process. All you had to do was walk into the nearest bank, fill up a form, and that's it, your account is open. There was no concept of KYC or know your customer at that time. And we were given books like this called a passbook. By the way, my account number was just a 2-digit number, hard to believe. And here, every single transaction that I made was actually handwritten by somebody at the bank, which also meant that my account was stuck to that particular branch of that particular bank. So if I had to move money from that branch to another branch of the same bank in the same city, it would still take at least 1 working day. Sending money to another bank in the same city, 3 working days. Sending money to a bank in another city, 10 to 15 days. Sounds ridiculous today. I mean, today you just pick up your cell phone, click a few buttons, and you can transfer money anywhere within seconds. And that's the reason financial technologies have become so important, because they enable banks, stock exchanges, insurance companies, and so many other financial service providers to provide services extremely fast, extremely efficiently, and extremely securely. Now, what do we really mean by financial technologies? Fintech or financial technology is a $5 trillion industry with more than 12,000 startups working in it. But what does it really mean? Any technology which is going to improve financial services, we club it under the name financial technology. Let's take a few examples. I'm sure all of you have heard about artificial intelligence. The name is slightly misleading. It's not really a computer mimicking a human being, but yes, a computer trying to think like a human, trying to intelligently apply certain algorithms, certain ways of thinking. One of the best examples of artificial intelligence was when a computer defeated the reigning chess champion several decades ago in a game of chess. So that was considered to be one of the most difficult games in the world. Something computers were not supposed to be better at than humans, but a computer was able to defeat. I think it was Gary Kasparov at that time. Let's take an example of where we could apply artificial intelligence to banking services. So after the 9/11 attacks that happened in the US, a company came out with a very interesting method of detecting a potential terrorist. So they developed this algorithm which would connect more than 100 different parameters about bank account holders and then try to predict which one of these is likely to be a terrorist. And they were looking at all sorts of parameters, including, of course, the religion of the person, the height of the person, the weight of the person, the address which has been provided, and how far that is from certain places of worship. So like this, so many different factors were taken into account, and they were able to quite accurately predict which of the bank's account holders was actually a potential terrorist. Let's take another technology, machine learning. So let's say there are millions of credit card holders. All their transactions are fed into a system, and then the bank makes a set of rules. So let's say me, Rohas Nagpal, most of my credit card transactions happen from 9 to 5 on weekdays from India. Now one fine day, if my credit card is used in an online transaction from another country, or maybe at midnight, immediately the computer could flag it that this seems to be a fraudulent transaction because it doesn't match the pattern that has already been established. So that would be an example of machine learning in action. Another technology you may have heard about is called blockchain. Now blockchain technology, which was born with Bitcoin, basically does 2 things. One is it can give you immutable data storage, which means you can prove in a court of law that the data held in the blockchain has not been tampered with. And secondly, it can give you smart asset lifecycle management features, which basically means you could replace the entire capital markets with a single blockchain. So you wouldn't need stock exchanges, depositories, custodians, and so many other entities. Now, fintech is today a $5 trillion industry, and there are more than 12,000 startups working in the field. In this video, we are going to have a detailed look at the Fintech Law ecosystem in India. Before that, I'll just briefly introduce myself. I started my career in technology in the early 1990s. In 1999, I completed my law and co-founded Asian School of Cyber Laws. From then till about 2015, I worked extensively in tech law and cybercrime investigation across 18 countries for various industry sectors, especially banking and financial services. In 2015, I co-founded PrimeChain Technologies, which is a blockchain startup which develops solutions for BFSI. And I've had a passion for financial technologies and fintech law for several years now, and that's the reason I've designed the program in financial law, which I am going to discuss in this video. I've divided this program into three parts: securities and financial assets, regulated entities, and regulators, tribunals, and enforcement agencies. So let's start with the first part, financial assets and securities. Now, when we talk about securities and financial assets, we can divide them into four categories: debt securities, equity securities, hybrid securities, and derivatives. Now, when we say debt, what do we really mean? Debt is something like a loan which has to be returned. So there's a fixed time period, there's a specific interest which may be there, but the money has to be returned. That's the critical part. But when we talk about equity, we are talking about risk, we are talking about ownership, and money need not be returned. Of course, if a company shuts down or goes bankrupt, all its assets are liquidated. If money is left, it may go back to the equity shareholders. But fundamentally, when we talk equity, in your mind, you know, it represents ownership. When we talk debt, it represents loan or something that is going to be repaid. An asset which doesn't fit into these two is what we could term as a hybrid, unless it comes under a category called derivatives, which we are going to talk about in detail. But a derivative, as the name suggests, is something which derives its value from something else. Now, debt securities could be of various types. We have bonds, we have call money, notice money, term money. We have commercial paper, government securities, non-convertible debentures. Now, because of the way the Indian law is structured, we usually divide debentures into two parts: non-convertible debentures, which have a validity of up to 1 year, and others, because the law which applies to them is a little different. When we talk about equity shares, one is of course an initial public offer where for the first time a new company is going to issue its shares to the general public. Once a company is already listed on the stock exchanges and it wants to come out with another issue, it usually does something called a rights issue. So you may be aware of the recent Reliance rights issue, one of the biggest in the world which happened. Basically, in a rights issue, you are giving existing shareholders a right, but not an obligation, but a right to buy further shares at a predetermined price and on a predetermined ratio. Then if a company does very well, it may decide to reward its shareholders by giving them free or bonus shares. So this is another thing which is covered when we talk about equity shares. We also have the concept of sweat equity. Now, sweat here means, like in Hindi we say khoon pasine ki kamai. So what we mean by sweat is pasina, or the hard work that somebody puts in. So here what you could see is that it's not just money that you can pay and get shares of a company. If you're part of this original team of the company and you've worked for the company, you could be paid or remunerated or rewarded by way of equity shares, and we call them as sweat equity. It's a little different from something called ESOP, which you may have heard about, which is employee stock options. Now, a lot of startups, especially tech startups, they give their employees something called an ESOP, which is an employee stock option, which is an option, not an obligation, but an option to buy further shares of the company at a predetermined price on a predetermined date. On that particular date, if the real value of the company's shares is below the price at which they can buy, then obviously they can choose not to exercise their option. If that price is higher and they feel they will make a profit, then they can choose to exercise that option. Other important issues when we talk about equity shares are the prospectus, the kind of documents that need to be submitted when we come out with such kind of issues, as well as allotment. So suppose there is an issue, X number of shares were to be allotted, but more than that have been bid for or applied for by potential shareholders, then on what basis are we going to actually do the allotment? Also, there is a concept called private placement of shares. So these are all the various kinds of issues that we are going to deal with in this program. Moving on, we have a concept called derivatives. So a derivative derives its value from some asset. Let's take a very simple example. So let's say I'm a farmer. I grow corn. You happen to be Kellogg's, which is a company which buys corn and then produces cornflakes and sells it. Now, as Kellogg's, You know that you have to keep producing a certain quantity of cornflakes and selling them. You do not want your supply chain to be impacted. So you could predict how much of corn you need to buy every month for the next few years. Now I, on the other hand, am a farmer growing corn. Now I'm worried that the price of corn may fluctuate, but it takes a few months for me to plant the corn and then actually harvest it and sell it. During that period, what if the price falls? I'm going to lose money. So what I could do is enter into a contract with you saying that 6 months from now, I'm going to sell you so much corn at so and so price. And this is an example of a derivative contract where we are making the contract based upon a future transaction in the purchase and sale of corn. Now this derivative asset, which in our example is corn, could also be gold or silver or any other kind of standardized asset. We don't usually find such contracts in things like eggs because you cannot unify all the eggs. They don't look the same. They don't last very long, which is why you don't find such kind of perishable commodities. But things like gold, silver, even things like rice, which can be standardized, all this can be used as the base for derivative contracts. Now, when we talk about derivative contracts, we are going to talk about things like futures, forwards, options, wherein we have call and put options. We also have the concept of swap, arbitrage, and hedging. Now, something which doesn't fit into all this is what we put into the category called as a hybrid financial asset. One example of this could be a preference share. So on the one hand, it has certain characteristics of equity shares in the sense like you may end up losing your money, the return may not be fixed, but it is not actually pure ownership. It is sort of like a debt also. Hence we put preference shares under the category of a hybrid security. Another example would be Bitcoin and other virtual or cryptocurrencies. By the way, virtual currencies and cryptocurrencies, it doesn't mean the same thing. Virtual currencies is a broader term. Cryptocurrencies is one part of it. So you may have heard about things like Bitcoin, Ethereum. All these come under this category. Of course, in countries like India, Bitcoin is considered illegal because it can be very easily misused for money laundering. So these are some of the concepts which we cover under hybrid securities. We are also going to cover equity linked notes, depository receipts, and security receipts. Now let's move on to the next topic, which is regulated entities. This is divided into three parts again. The first is pooled investment schemes. The second is regulated intermediaries. And then of course there are other entities that we're going to talk about. Now what do we mean by pooled investment schemes? The simplest example could be a mutual fund. I'm sure most of you invest in mutual funds. So what really happens? We take our money and we give it to some third party expert who's, let's say, very brilliant in managing the stock market. I mean, they know what kind of shares to buy and sell to give us a good return. So the important point here is the investors are not taking the investment decisions. We give our money to somebody else and we trust that other person to take investment decisions on behalf of this money that we have provided. This pool of money or investment that has been created. So that's the very basic example of what we mean by pooled investment schemes. Now there are various types, mutual funds being one of them. You may have heard about angel funds, venture capitalist funds, or SME funds which invest in the small and medium enterprises, or infrastructure funds which invest in infrastructure projects. All these come under the concept of pooled investment schemes. Then we have regulated intermediaries. One example would be a commodity exchange where metals, agricultural products can be traded. This is similar to a stock exchange, but where a stock exchange primarily involves the equity shares of companies, a commodity exchange involves commodities like agricultural products, metals, etc. Then we have the concept of credit rating agencies. So now, even though a particular company is very famous and it's known to be extremely wealthy and very secure and it survived for decades, there's no guarantee that the company is going to exist forever. So if I am going to invest in the debt securities of a company or I'm going to give them a loan, I need somebody, an independent third party, to look into the details of the company and tell me how credit worthy they actually are. And that's primarily what credit rating agencies are supposed to do. In fact, you may be aware that even countries are rated, and if their rating falls, they have to actually end up paying a lot more interest to raise money globally. Then we have custodians. Now today, shares and other securities are held in dematerialized form. So custodians are entities who are going to hold these securities for their customers and provide a lot of incidental services like collection of dividend, various accounting and other such services. Now since we spoke about something called dematerialization, that's where an entity called a depository comes in. So earlier, shares and other securities would be in paper form. Subsequently, to make the process more secure and efficient, the concept of dematerialization came in, where you could hold these securities just like the way you have money in your bank account. Now, when you have money in your bank account, primarily it's just numbers in some electronic database. Well, that's very similar to what shares are today. They are numbers in a system maintained by an entity called a depository. So in India, we have two depositories. They do not directly interact with us. They interact through an entity called a depository participant. So in this program, we are going to cover all these intermediaries and in detail what are the laws that relate to them. We are also going to look at it from an insurance point of view. So where we have insurance repositories where you can hold your insurance policies in an electronic format. Here we have insurance self-network platforms and insurance web aggregators. We're also going to cover a very interesting new innovation which is called as the Trade Receivables Discounting System or TREDS. Just to give you a brief background about how this operates. So let's say that I'm a vendor and I provide tires to, let's say, a very famous car company. Let's take an example of Toyota. Now I provide them these tires. When I provide them a consignment of tires, I also give them an invoice saying these are the number of tires and this is the total price. When I supply this, some experts from the Toyota team are going to verify that the tires match their quality which is required, and then they would accept my invoice saying yes, we will pay you this money 3 months from now, because that's the payment cycle they follow. But I, being a small vendor, I need the money immediately. I cannot wait for 3 months. So I could take this invoice to somebody, could be a bank or could be a trades exchange, and based on Toyota's creditworthiness and not mine, based on Toyota's creditworthiness, they could give me a loan against this invoice. So let's take an example, a 100 rupee invoice. Somebody could bid that, okay, I will give you 97 rupees today, and 3 months later when the invoice matures, I will get the entire 100 rupees from Toyota. So because I am a small vendor and my creditworthiness may not be much, I may not have been able to borrow money at that rate. But because of Toyota's creditworthiness and because they are the ones who are finally going to pay, I would be able to get my money early. So there's an entire system for this in India, which is covered by the factoring related laws and rules and regulations. We also have other regulated entities in India, one very important one being account aggregators. So these are some of the innovations which you would find primarily in India and not in most other countries. So an account aggregator basically holds your financial information. And of course, there are various use cases around why they would hold this. But it's not just anybody who can become that. You have to be licensed, you have to follow certain norms to be able to work as an account aggregator. So we're going to look at that in detail. We also have foreign portfolio investors. We have a very interesting concept which I think only exists in India known as payment banks. You may have heard about or used the Paytm payment bank. So we are going to discuss what payment banks are. We're also going to discuss peer-to-peer lending. Now this is a very interesting new innovation in the world where instead of customers giving money to a bank which then lends it to borrowers, we can directly lend money to other people. So suppose there's somebody in another city who needs a short-term loan to maybe do up his house. He wants to renovate his house. He needs money for 6 months. Instead of going to a bank and paying a very high rate of interest, he could directly put this requirement on a peer-to-peer lending platform. And individuals like you and me, if we feel that this particular person sounds creditworthy, we could directly lend him the money, thereby removing the banks from the equation. In the third part of this program, we are going to look at the regulators, tribunals and enforcement agencies. Now, when it comes to financial regulators in India, there are 7 of them, namely the Competition Commission of India, the Financial Intelligence Unit, Insolvency and Bankruptcy Board of India, Insurance Regulatory and Development Authority of India, Pension Fund Regulatory and Development Authority, Reserve Bank of India and the Securities Exchange Board of India. These will be covered in this program. Then we have the financial or the fintech tribunals. There are primarily three of them: the National Company Law Tribunal, the National Company Law Appellate Tribunal, and the Securities Appellate Tribunal. Then we have 5 enforcement and investigation agencies, namely Central Bureau of Investigation, Central Board of Direct Taxes, Central Board of Indirect Taxes and Customs, Directorate of Enforcement, and the police agencies in various states and union territories. Then we have the other relevant fintech agencies, which is the National Payment Corporation of India, the Clearing Corporation of India, IDRBT, and the Gift City Special Economic Zone for IFSC, which has been set up in Gandhinagar, the first of its kind in India. All these are also going to be covered in this program.